we're still talking about the Nigerian banking system, and Lagos-based ratings firm Agusto and Company is forecasting a 13% non-performing loan ratio in the short term for the banking industry. This is a review of an earlier projection that the NPL ratio will moderate at 9.4%. Agusto and Company relates the revised forecast to the impact of COVID-19 and associated risks. Ahead of financial institution ratings at Agusto and Company, Mr. Ayokunle Olubumi joins us now for more analysis. Good morning, Ayokunle. Now, before we get into your report, let's hear your thoughts on the IMF approval of $3.4 billion for Nigeria.
Okay, good morning. Thank you for having me. As you know, yesterday, the IMF approved the support facility, 3.4 billion support facility for the Nigerian government. And this is actually a positive for Nigeria, for both the federal government and also the CBN. It's also important for us to note that this facility doesn't come with the conditionality of IMF programs that Nigerians are always sensitive about. Also, for the time of the facility, we have a moratorium of 3.5 years, and also the repayment of 5 years. Now, for the federal government, as we all know, the revenue of the federal government has been negatively impacted by the low prices of crude oil. And this facility will provide enough revenue for government to fortify the COVID-19 pandemic and also to boost the economy. As we all know, over the last couple of months, the external reserves has been on a decline, given that crude oil, which is the major foreign exchange earner, has actually been on a decline. This particular facility will also boost the external reserves. Presently, the external reserve is at 3.5 billion, but with this 3.4 billion, it will actually rise to 37 billion. So that will also support the CBN in meeting foreign currency obligations of Nigerians.
Now, let's get into your report now. Yours and that of Moody's Investors Service came in at about the same time. Tell us why the COVID-19 is the bane for the NPL ratio review.
Okay, as we all know, COVID-19 has distorted the global economy. And for us in Nigeria, the first impact that we could see is on the crude oil prices. And like you all know, the measures adopted to contain the spread of COVID-19, but lockdown of different economies, the planes are packed. So because of that, demand for crude oil has actually gone down. Presently, we have a glut in the market. And given that about 60% of government revenue comes from crude oil, and about 90% of our FX earnings come from this particular product, this has already affected the revenues of government. And remember that the government is the largest spender in the Nigerian economy. And the impact of lower government revenues has a ripple effect on the economy. Also note that the COVID-19 has distorted the global supply chain. And unfortunately, a lot of our manufacturing companies import most of their inputs. Although we acknowledge that since 2016, when we had the FX crisis, most companies have tried to domesticate most of their inputs. But up to now, a significant proportion of their inputs are still imported. So the industry will also be affected because most companies will not be able to get those inputs that they actually import. Unfortunately, most companies will try to even get those products locally, but it's going to be expensive. However, given what we have presently now, given the declining purchasing power of consumers, it will be very difficult for companies to completely pass the cost to the customers. So definitely this will affect the performance of some industry. Directly the oil and gas industry and also general commerce manufacturing will also be affected.
What are the other highlights of your 2020 banking reports, asset quality and, of course, other metrics?
Okay, for asset quality, what we expect the industry to do is this. Presently the CBN has a minimum LDR LDR policy, meaning that banks must lend at a minimum 65% of all their funding. So banks will try to meet this 65% ratio. However, we see lower risk assets creation in 2020. Why? Because banks are going to strengthen their credit risk management and their underwriting standards. We see more banks going top notch, disbursing more loans to top corporates that are focusing on getting most of their inputs locally. And remember what I said earlier, Given the discussion that we have globally because of COVID-19, the NPL ratio of the industry will actually go as high as 13.5%. However, let me also mention here that although we see lower loan creation, there will still be a significant growth in the loan book. One, from the impact of the devaluation, which will bloat the loan book of the industry, specifically for banks that have significant foreign currency loans. As at December 2019, about 47% of the industry loan books is foreign currency, is denominated in the foreign currency. Also, the CBN forbearance, which allow banks to restructure loans extended to businesses that are impacted by this pandemic, will reduce the pay down on some loans. So that will actually reduce the need for banks to create significant amount of loans to actually meet the 65% LDR ratio.
The federal government has also just localized its external borrowing plans of 850 billion naira. Do you consider such potential exposure to government securities as helpful to the banks?
Okay, for the banks, it's going to be a mixed bag for the bank. For instance, now, although we expect to see more borrowings for the federal government, given the state of the macroeconomic environment and the fiscal position of the government, we see the government borrowing more locally, and that will actually increase the interest rates on those particular borrowings, given the increased pressure for them to actually get those funds. As a result, not only will the interest rates on government bonds increase, the interest rate that banks also pay on customer deposits will also be high. That's on the flip side. The bank can also earn more revenue by investing in those funds. And if you recall, about 35% of the industry's non-interest income came from fixed income securities trading in 2019. So this will also provide some securities that the banks can actually trade. Unfortunately, it will increase the interest expense of banks, which will moderate the profit for 2020.
Well, already now, the Debt Management Office looks to raise between 75 billion naira and 165 billion naira in the second quarter of the year. What will this change in the non-interest income of the banks?
Okay. Yeah, like I said earlier, the banks now have more securities to trade with. And now, given that banks, like we said earlier, that banks will actually reduce their risk assets creation. A lot of banks are going to deploy more funds into government securities and even trading on those particular securities. And that will further support the non-interest income of banks.
Do you have any particular ratings for the industry, just like Moody's?
Yes, our current rating for the banking industry is triple B with a stable outlook. However, the rating is currently undergoing review. In a couple of days, the final rating for the industry will be out. But the one that we had presently is triple B with a stable outlook.
Well, while we wait for the final one to be out now, the oil and gas sector has been affected by the falling oil prices at the international market. So tell us how banks will be able to deal with credits to this sector, which accounts for about 30% of the loan portfolio as at the end of 2019.
Okay. As you mentioned, the industry's loans to the oil and gas sector accounts for about 30% of the industry's loan book as at 31st December 2019. And about 80% of those loans are to players in the oil and gas and the upstream segment and also the servicing segments. And these are the sectors that are significantly affected by the lower oil prices emanating from the low demand for crude oil, which we currently have in the market now. So the question now is, how will banks navigate through this terrain? Because that's part of the palliatives by the CBN to moderate the impact of the pandemic. The CBN grants banks forbearance to restructure loans to businesses affected by the pandemic. So we expect a lot of banks actually leverage these to restructure some of these loans. Having said that, we also believe that the NPL ratio in the oil and gas industry will also increase significantly, given that a large proportion of those loans related to the oil and gas upstream and to an extent to the servicing segment are foreign currency denominated. So they'll be bloated by the devaluation of the naira.
Well, the CBN has also been debiting the banks in CRR, albeit some refunds. What would change in the system?
Okay. Currently, the CBN has implemented aggressive implementation of the CRR policy as part of their liquidity management system to stabilize the foreign exchange market. And currently, although officially the CRR rate is 27.5, a lot of banks have their effective CRR in excess of 40%, such that presently about 15% of the industry total assets is held in these cash reserve debit restricted funds that the banks don't earn any amounts on. Now, the question is, what if CBN actually allow banks to actually lend from those particular funds? On the average before, normally about 10% of the industry's total assets is in these restricted funds. But like I said earlier, it is currently 15%. So assuming CBN allows banks to access even 5% of the restricted funds, right, and to bring it back to 10% that which we normally have before, you will see that this, with an asset size of about 40 trillion, this would translate to, and if these funds are actually lent to top tier corporates at let's say 14%, this will translate to about 300 billion additional profits for banks. And this is about 0.9% of the return on equity for the industry.
Head of Financial Institution Ratings at Agusto and Company, Ayokunle Olubumi. Thanks for speaking with us on Business Morning.